Imagine knowing exactly what steps to take to ensure you never lose money investing and achieve your long-term investment goals. Well, who better to learn these steps from than Vanguard? It turns out that everything you need to know about investing successfully is in this document right here. Vanguard shares it year after year, but it's buried on their corporate page, meaning that it's not easily accessible by the average investor like you and me, so hardly anyone pays attention to it. But every year they include some new information in this document. So if you've seen it before, don't just stop watching, because there may be some new information here that you haven't learned about. This is what the performance of a good investment portfolio should look like. A steady increase in value over time with occasional declines along the way. These dips are quite normal because the market naturally goes up and down. Assuming this covers a 30-year period, which is how long most people invest before starting to withdraw money, this portfolio has done quite well. It did drop in value now and then, but overall it continued to grow. So how can we ensure that our portfolios follow a similar path? Well, according to Vanguard, it's actually quite simple. This chart shows the performance of the S&P 500 over the past 30 years. During that time, we had the dot-com crash in the early 2000s, when the market dropped 80%. Then the market fell about 50% during the 2008 global financial crisis. And most recently, we had a 20% decline in March 2020. Unsurprisingly, many people sold their investments during those market crashes, which turned out to be a huge mistake because the stock market increased more than 700% over this 30-year period. In other words, it delivered an average annual return of approximately 10%. So those people who panicked and got out of the market missed out on some huge long-term gains. Now the question here is, why did these people sell their investments when the market crashed? Well, we'll never actually know, but one of the reasons is that their emotions got the best of them, which, as Jack Bogle says, shows you that
when you act on the emotions of the marketplace, you're making a big mistake.
That's why, according to Vanguard, a key step in achieving investing success and reaching your long-term investment goals is to maintain perspective and long-term discipline. They argue that discipline in investing is the ability to stick over time to your investments. They say that while it's natural to want to react to market volatility, acting on that emotion can lead to an impulsive decision, like panic selling during an unstable market. So taking a long-term perspective can help us maintain discipline and avoid a potentially harmful emotional move. For example, this chart shows what would have happened if you shifted to cash at the bottom of the COVID-19 downturn and stayed there until the market recovered. As you can see, people who did that and then reinvested once the market recovered ended up with a return of only 7% across this period shown in the chart, while those who remained invested saw their portfolio return 27%. Now, before we judge these people for selling their investments and missing out on those big gains, I think it's important to recognize the harsh reality that staying invested for the long term, no matter how the market is doing, is much harder than it seems. Take this Reddit post as an example. This person asks, "Am I the only one who believes long-term investing sucks?" He goes on to say, "You have to control yourself for 30 years or more. And so, how do you plan to manage your selling temptation when the market is in drawdown? How do you ensure that you will never ever sell your holdings in a few years after you start investing if the market stays in the red for a few years?" While investing for the long term involves earning good returns, the real challenge lies in managing our emotions and making the right decisions during tough times. But there are two reasons as to why I think controlling your emotions for 20 to 30 years or even more is actually harder than it seems. The first reason is that, unfortunately, our psychology works against us. In other words, our behavior matters more than what returns we earn or what we are investing in. We have all kinds of biases, such as confirmation bias, loss aversion, or negativity bias that work against us. Think about it. It's in our nature to take action when we think something has gone wrong. For example, if our car breaks down, we try to fix it. And the same goes when markets are falling. It's tempting to think something has gone wrong and feel urged to do something. For example, if you think the stock market is overvalued and about to crash, and you're sitting in cash on the sidelines, you're going to seek out information that confirms that view. So when you go on YouTube, you're likely to type in things like reasons why the stock market is about to crash, because you actively want to find information that is going to support your view and make you feel better about your position. But couple this with the negativity bias and we end up making flawed investment decisions. And the finance and investing industry knows about these flaws very well, which is why you see article after article and video after video filled with negative headlines. But don't forget that their incentive is to get you clicking on the article. And the second reason as to why staying invested over the long term is much harder than it seems, although this doesn't apply to everyone, is simply because many people haven't experienced a market crash before. Sure, keeping a long-term investment mindset and holding onto your investments is easier said when the market is going up. But when things are going badly, the story is completely different, especially if you have a large investment pot, because you have more money to lose. And unless you've seen it before, then you'll just think that those times are behind us and the only way was up. However, the bottom line is that the stock market declines on a regular basis, and history teaches us that it always recovers and over time tends to go up. This chart shows that over the past 70 years, the average bull market, which is when share prices rise by 20% or more, has returned 120% and lasted around 6.5 years. Meanwhile, the average bear market has lasted just over a year, and returns have fallen 43%. Now, sticking to your investments over time is one thing, but a key aspect that goes hand in hand with maintaining discipline is to increase your annual contribution as well. This chart shows how long it would take you to reach $500,000 or pounds using different contribution rates and market returns. And it assumes an initial contribution of $10,000 and annual contributions of $5,000. As you can see from this example, although the annual market returns stayed lower, increasing the contribution rate reduced the time needed to meet the $500,000 objective. By the way, I'm using dollars because I couldn't find this chart in pounds, but it's pretty much the same idea. In this scenario, an increase in the contribution rate of 5% per year while earning a return of only 4% was much better than not increasing your contribution at all and earning a better return. In other words, increasing the amount of money you invest each year can be a more powerful and reliable factor in building wealth than chasing higher returns. Okay, that's all good and nice. We will do our best to control our emotions and increase our annual contribution. But due to our behavioral biases that we talked about earlier, surely it's not that easy. So how do you make sure that you will actually maintain the discipline required throughout your investment journey? Well, if you hop in your car and start driving, you'll end up somewhere after a few hours. Maybe in a nice park or maybe stuck in traffic. If you want to make sure that you make the most of your journey and reach your destination, you have to plan. How much fuel do you need? How much time do you have for the drive? What route to take, etc. It's the same in investing. That's why the next step shared by Vanguard is to set clear investment goals and plans. Because these are the ones that will guide you throughout your investment journey and dictate the actions that you will take. For example, let's say your goal was to reach £1 million. In that case, you will need to work out how much time you need to invest for to reach that amount, how much you can afford to invest, the potential return you will need, the level of risk that you're comfortable with, and so on. Therefore, it's important to identify why you're investing in the first place and how you plan to do it. Once you're clear about your long-term goal and have a plan to achieve it, maintaining discipline gets easier. Because according to Vanguard, it's your goal and your plan that will help you stay focused and avoid expensive investing mistakes and keep calm when markets get turbulent. At the same time, Vanguard also argues that having clear goals can help you pick the right investments and avoid engaging in what they call fund shopping. This basically means investing in funds that seem attractive without thinking whether they have a place in your portfolio. For example, if an emerging markets fund has delivered good returns over the past 5 years, it may be tempting to include it in your portfolio in the hope of earning higher returns. But by doing that, you may end up making your portfolio riskier and harder to manage. Which is why a clear investment plan, taking into account all these factors that we talked about, can help you make the right decisions and stay focused on your goal. This being said, the driving force of your investment plan is an asset allocation suitable for the portfolio's objective, built on realistic expectations for risk and returns, using diversified investments. For Vanguard, both asset allocation and diversification come under the next step, which is to keep a balanced and diversified mix of investments. The idea here is that you need to find the right mix of investments that match your risk appetite and return expectations. If we take the stock market as an example, we all know that the higher allocation to stocks tends to provide better returns, but they tend to bounce around more, whereas bonds tend to offer lower returns, but they're more stable. Now, the thing is that although stocks are riskier than bonds, by excluding them in an attempt to escape the volatility that comes with them, you may face other problems, such as not achieving enough growth to meet your goals and inflation potentially outpacing your portfolio's returns. Which is why it's really important to work out an investment mix suited to your goals, risk appetite, and how long you plan to invest for. Typically, for younger investors, a higher allocation to stocks makes more sense, and vice versa. Nevertheless, regardless of whether your portfolio tilts more strongly towards shares or bonds, Vanguard's tip is to always make sure it's diversified. That doesn't mean you should invest in just anything. Nowadays, with so many index funds, ETFs, and stocks ready to invest in, you're made to believe that if you don't invest in a certain fund or stock, you're missing out on a lot of gains. However, the truth is that you don't have to buy the latest fund or the hottest stocks this week. As long as you're investing in broad market, low-cost index funds like the S&P 500 or even the entire world, you don't need to spend a second of your time wondering whether you should buy certain companies, because you own them all. And while you can't control what your returns will be, you can control how much you pay for your investments. That's why keeping fees low is the last of Vanguard's principles, and in my opinion, the most important one. People often forget that fees could be one of the deciding factors of your future returns, because the compounding effect applies to them too. Take this chart as an example, which shows what £100,000 could look like after 30 years. For simplicity, it assumes a hypothetical annual return of 6%, which is reinvested. As you can see, in the early years, the difference between an annual fee of 0.10% versus 0.70% may seem insignificant, but when they are compounded over many years, you end up losing a lot of money. In this example, you will lose almost £100,000 over this 30-year period. Also, don't forget about platform fees too. They can also reduce the value of your portfolio over time. Normally, when you buy something, the more you pay, the better the product is. But in investing, higher fees doesn't always mean higher returns. In fact, it tends to be the other way around. The less you pay, the better the returns you can expect to receive. Vanguard has found that lower cost funds have historically outperformed higher cost funds after charges. As you can see from this chart, funds with the lowest fees had an average annualized return of 11%, and those with the second lowest costs returned 9.1% a year. However, the funds with the second highest fees had an average annualized return of 7.5%. And finally, those with the highest costs returned only 6.5% a year. Therefore, if low costs are associated with better returns, then it makes sense to invest in cheap products. And typically, index funds and ETFs are some of the most affordable investments available to us. So watch this video next to learn about the cheapest index funds for long-term investors.